Okay, we've done a lot of videos talking about timing the market, but what about timing your contributions to something like your 401k? Would it ever make sense to kind of play a little bit of games throughout the year with how you're contributing to your 401k, adjusting those amounts, whether the market's up or down, to try and just time that? Interesting thought. We're going to ask Frank Oliver on today's show, financial advisor, whether it's ever wise to do something like that. All right, Frank, so full admission, this question's from me. This is me overthinking things, probably.
Okay.
But I was interested in
little engineer mind going on there?
Yeah, maybe a little bit. So, no, I was just curious about something because I'm not trying to necessarily time the market.
Right.
I know the red flags that come along with that from having done this show with you. But I am wondering, well, should I be plowing as much money as I can to a 401k at the beginning of the year? Or should you be more delicate with the contributions at the front end of the year? And then if the market takes a dip, start going with more contributions at that moment to take care, buy stocks on sale sort of mentality.
Sure.
My overall plan is still maximize contributions by the end of the year. So I don't want to leave anything on the table. But am I overthinking it and getting a little too fancy trying to do something along those lines?
Yes.
Okay. Great video today. Thanks for joining us.
That's all we need right now. Again, that's you said you're not trying to time the market, but in reality, that is kind of a market timing strategy is what you're trying to do. And I know it sounds like what you're trying to engineer here is to listen to what's going on with the economy, start off slow, and if there's some strong indicators that the market's going to fall, then that's when you're going to start plowing some more money into the 401 so you can take advantage of that dollar cost averaging and buy some shares at a lower price. Is that what you're thinking?
Yes, pretty much.
Yeah. Again, it's going to be tough to time the market.
I'm still going to miss that time in the market, though, if it keeps going up. I'll then be buying at the end of the year. If things are up higher, I'll be buying.
That's exactly right. Yeah. So
is it more so then? All right, let me change my strategy.
Okay.
All right. So I'll contribute at just kind of a normal amount at the beginning of the year.
Okay.
But then if it so happens, so I'll be dollar cost averaging. But if it so happens that the market takes a dip and I have the ability to now really increase my contributions, would it then make sense to go ahead and do that in the middle of the year versus waiting till the end of the year?
Yes, absolutely.
Okay.
Yeah, if you see a market correction, or we're in the middle of a market correction, and the S&P,
I can go and change my contribution from
step them up
4% to 10% or something.
That's absolutely right. Absolutely right.
That's not necessarily
that's a good
bad
strategy.
Okay.
Yeah,
all right.
absolutely.
We found a middle ground.
There you
I
go.
like it. Okay, that's excellent. But bottom line, let's not try to time the market. That's still where some of that danger comes from.
You could talk to the smartest professional asset manager out there with Goldman Sachs, J.P. Morgan, any of these large firms, and they will tell you the same exact thing. You cannot time the market.
Yeah. So keep those contributions rolling in nice and regular. And sure, if there's a big crash and you can then pummel more in there in the middle of the year, go for it. But don't bank on it.
There was a big boom during COVID, honestly. If people would have took advantage of that crash during the pandemic, it would have been a big profit maker. But I think people got frightened with the pandemic, rightfully so, and maybe missed out on some good opportunities.
As always, there's that mental component where this sounds great, but then talk to me next year if we are in the middle of a crash and ask me, are you putting more money in now that the market's crashed?
Right, yeah. And it's hard to do sometimes. So that market's going down. You just don't think it's going to stop, but it does. The market always recovers. We just don't know when, but it's a good opportunity for you.
Those emotions start taking over for sure.
They do.
I would have probably had a pretty good answer to this question already if I had read Frank's book, The Time Blueprint, which you can pick up a free copy of, by the way. He's going to hold it up right there for you. The time is now. He's going to walk you through the planning process, some of the most important things that you need to know about your finances and retirement planning, taxes, income, money in general, and estate planning. Those are kind of that's the T.I.M.E, of course. This is filled with great insights into financial and retirement planning. Frank, thanks for providing the book and for providing the answer to
go read it, would you?
My question today. And you're going to get better educated about finances if you do so. Until next time, we'll have a great week, and we'll see you again on the Retirement Blueprint.
Thank you.
Investment advisory services offered through Creative One Wealth LLC, a registered investment advisor. Oliver Asset Management and Creative One Wealth are unaffiliated entities. Licensed insurance professional. This information is for educational purposes only and should not be construed as advice or a recommendation for your specific circumstances. Investing involves risk, including possible loss of principal. Insurance product guarantees are backed by the financial strength and claims paying ability of the issuing company. We are not affiliated with any government agency and do not provide tax or legal advice.